Warsh kicks off Fed chief era with sweeping review as rates remain unchanged. The old approach just got more expensive. The practical edge now comes from changing process, timing, and tooling together. We will map trigger, incentive shift, and downstream impact before the close. 3 weeks later, he's already signaling a complete reset of how the Fed operates. Here's what just happened at the FOMC meeting. Rates stayed at 4.25 to 4.5%. That's the headline. But beneath it, there's a structural shift that investors are only beginning to price in. Warsh's memo to the committee, circulated internally before the vote, outlined a sweeping review of the Fed's inflation framework, its communication strategy, and its balance sheet philosophy. This isn't a rate cut announcement. This is a philosophical reset 3 months into his tenure. And it matters because it signals what the Fed will actually do next, not what the bond market is currently assuming. Let's start with the framework shift. The previous Fed chair built a flexible average inflation targeting system. Warsh is signaling a move back toward a stricter, more transparent rule-based approach. Why? Because inflation expectations are starting to creep up. Not dramatically, but enough that he's moving preemptively. This is the opposite of the narrative you've been hearing. Everyone expected rate cuts this year. Warsh's review suggests the opposite. The Fed is preparing to hold or potentially hike later if inflation data deteriorates. Second, his communication playbook is different. Warsh is known for being precise, data-driven, and willing to shift publicly if the data shifts. He's already telegraphed that the Fed will move slower on rate cuts than markets priced in December. The bond market had been assuming 3 to 4 cuts by year-end. Warsh's first meeting. He signaled 0 cuts are more likely than 2. This alone has cascading implications. Here's where it gets concrete. If Warsh holds rates at current levels through Q2 and Q3, the 10-year Treasury yield stays elevated. That means mortgage rates stay sticky around 6.5 to 7%. Refinancing activity drops. Housing demand softens. Tech valuations that priced in a rate cut rally get re-rated downward. This is already happening. The Nasdaq sold off 2.3% in the week after his memo leaked. But there's a second-order effect nobody's talking about yet. Warsh's emphasis on balance sheet efficiency signals the Fed will not resume QE even if growth slows. The previous chair kept QE as an option. Warsh is essentially removing that tool from the playbook. For investors, this means, if the market cracks and growth disappoints, the Fed won't step in with liquidity support like they did in 2020. This is a structural bearish signal for risk assets in a downturn scenario. Now, the contrarian angle. Warsh's caution on rates might actually be hawkish in a way that stabilizes markets long-term. If the Fed credibly commits to holding rates above neutral for longer, it kills 2 problems at once. It prevents inflation re-acceleration, and it prevents the Fed from having to hike aggressively later in panic mode. Markets hate surprise hikes. Warsh seems to be trying to eliminate surprise through transparency. That's worth something. Who does this impact most? First, leverage traders. Carry trades that relied on a weak dollar and lower rates are now unraveling. The yen is strengthening. Tech stocks that depend on low discount rates are repricing. Second, mortgage applicants. If rates stay at 6.5 to 7% for another 18 months, affordability stays crushed. Home sales stay depressed. Third, pension funds and insurance companies. They were bracing for cuts to compress spreads. Now they get extended duration upside. Their bond portfolios gain in value. For Indian markets and the rupee, this matters too. If the Fed holds rates higher for longer, the dollar strengthens. The rupee weakens. That makes imports more expensive and Indian exporters more competitive. On balance, it's slightly positive for Indian IT and manufacturing. But it's negative for domestic consumption if inflation picks up on import costs. Here's what to monitor over the next 72 hours. First, watch the Treasury curve. If the 2 to 10 spread keeps flattening, it signals recession fears are rising faster than Warsh's hawkishness is being priced in. Second, watch the Fed funds futures market. Options traders are repricing the probability of the next move. If it drifts toward a hike instead of a cut, liquidity dries up fast. Third, watch the dollar index. A break above 105 signals capital flows are rotating towards safety and away from growth assets. Warsh's first meeting wasn't about what the Fed did. It was about what the Fed won't do. And that reset is still rolling through markets. This is worth paying close attention to over the next quarter. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next.